The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to the Become a Pro course. I am, of course, your host, Robert Blackwell, and have the pleasure to walk through today's lesson. So welcome here to Forex.Academy. Of course, we'll proceed through. First of all, we like to outline the following disclaimer. Of course, there is risk inherent when deciding to trade the financial markets, so do be aware, of course, of the risks involved. Now, just a few pieces of housekeeping before we begin. Of course, this is a live interactive webinar, so do make use of the opportunity to ask questions throughout. Of course, you have the chat box there located on the right hand side of your screen, so you can simply click the box. It opens up and you can obviously ask questions throughout the webinar. If you prefer to wait to the end, of course, you can of course ask questions towards the end. As a live webinar, of course, it's recorded. We do upload them within the members login area in a 1 hour period, so you'll have it fully there for revision within roughly 1 hour or 2 hours. So do look forward to that, of course, to revise. And of course, the Q&A session will detail some of your maybe some of your grievances or some of your issues with today's lesson, and we can really talk them through in a lot more detail. Okay. So we are now approaching the end of week 2, of course, with the Become a Pro course. We've learned quite a lot in terms of how to fundamentally analyze the markets. Yesterday, we discussed sector analysis and how important different economic sectors are in terms of pricing many of these assets we like to trade. You know, as a fundamental analyst, of course, we do take into effect the forces of supply and demand, and that's more generally, that's what rules markets. That's these forces that generally cause buyers to jump in buying a certain asset class over a given time period, or of course are looking to sell, fundamentally looking to sell such an asset if there's too much supply for that asset perhaps. So today we'll discuss capital and trade flows. Again, very, very significant in terms of how you position yourself as a trader. Just a few weeks ago there, I was trading an equity index where I seen that there was some commentary on the fundamental side that there was a lot of US dollar flows going into European assets yet again. So that led me to speculate, of course, that we had found a rough area, a bottom of as we've seen the equity sell off there in the US and Europe, and obviously that tended to price into these assets in a little more with quite a large substantial amount of US dollar flow going back into European equity markets. So that's the sort of stuff we're going to be looking at today, how to properly analyze the flow of global capital and trade and how that might affect all of these assets which we trade. So let's jump in. Of course, what I like to define, guys, is of course capital flows versus trade flows, because they are very, very much inextricably linked. Okay, so capital flows occur almost instantaneously. When we discuss capital flows, we are more focused on the price movement of money. So cash that flows from one nation or one region to another, whether it's a form of investment, whether it's a foreign exchange transaction, that is effectively what we are looking for. Trade flows occur at a relatively slow pace. Okay, so trade flows is simple business creation, large business creation between continents, between countries and nations, and trading partners and neighbors, of course, as well. So because cash is, it's almost instant. It is instant nowadays. If you're sending a large cash amount from one large financial institution to one other, that is an instant transaction, and of course it can influence an increase in demand for that currency or a decrease in demand for the currency. That is effectively what we'll be looking at today. So let's jump in to define what we define as capital flows. Okay, capital flows measure the net amount of a currency that is being purchased or sold due to capital investments. Okay, so we're looking to measure the net amount. Okay, the total net amount of a currency that is being purchased or sold due to capital investments. A positive capital flow balance implies that foreign capital inflows into regional investment exceed that capital that is leaving the region, and we define them as outflows. Okay, so very, very basic. If we are the UK economy and we have what we call a trade balance, again we'll discuss, we are looking at our flows of income. Okay, capital flows of income. If we are tending to exceed the amount we're actually taking in from capital flow, then we're at a certain disbalance or a disequilibrium in terms of the capital flow coming into the economy. Again, a positive capital flow is one economy that focuses and implies foreign capital inflow into that region exceeds that capital that is leaving the region. Okay, so we see a positive capital flow balance. Hence, the demand for that country's currency will increase. Okay, appreciation. So we see an appreciative effect on the currency there. Alternatively, a negative capital flow balance indicates that there are more foreign investments being bought by domestic investors than foreign investors. Okay, so if you're a domestic investor, you're not doing all of your business. Certainly, you're doing a larger portion of your business abroad. Okay, so you're actually changing your currency into dollars to do business there with a US bank, perhaps with the US commodity exchange, or whatever type of investment you're of course doing. You're actually creating more output for international relations, international trade, than you are in terms of capital flow for the domestic nation. There will therefore be more capital outflows than inflows into the domestic country, which will decrease demand for that country's currency. Okay, and we define that as a depreciating currency effect. So that is effectively what we do. And as we look across, if you're an equity trader, you can trade the SMI 20, which is the Swiss market index. You could trade the IBEX or MEF, what we call it in the futures industry. It's effectively the 35 companies composing of the Spanish index. You can trade that as an index price. You can trade the German DAX. You can trade the S&P 500. You can trade the ASX 200 in Australia there. All of these countries and equity markets will relate to the amount of capital flow that is either moving into the economy or moving out, or vice versa. If there's a strong or severe disequilibrium between that function, one country is going to be working on a trade surplus and another on a trade deficit, which we'll get into in much detail throughout. So let us first of all pick here a positive capital flow balance and choose a more familiar country that we can describe. Okay, so we have the United States, and I wanted to bring in a new change of diplomatic, I suppose, or economic policy, which aims at changing the sort of disequilibrium that exists in the United States. So what we have is the President of the United States, Donald Trump. He signed there not so long ago the Tax Cuts and Jobs Act into law on December 22nd, 2017. Okay, so we understood this as the tax reform bill, and there was a lot of discussion on it, of course. But what did it mean for financial markets, guys? Again, I always like to bring these topics back to, well, how can we make money on these trading decisions? Among the many ramifications on the tax reform bill, one of Trump's key objectives is to bring tax breaks to large multinationals, US firms who create lots of jobs in other countries and of whom shelter their dollar profits abroad. Okay, so that was one of the main objectives. He wants to bring those well-earned US dollars home. He wants to create more money flow in the economy. He wants to create more jobs in the domestic economy. He wants to create that level of business that exists abroad from those US companies back into the US. Okay, so it's an understandable quest, of course, but how does it mean, what does it really impact in terms of those assets that we trade? So a couple of points here. Well, what is likely to be the capital flow benefiting firms such as Apple, Microsoft, and Facebook? Okay, what is likely to be the capital flow effect for benefiting firms such as Apple, Microsoft, and Facebook? Well, of course, they are making a lot of capital, of course, abroad, and they're sheltering these dollars for a specific reason. Okay, now that is because of tax benefits, of course, abroad. So if they're able to save on tax benefits by paying a much lower rate of tax in the US, they'll certainly do that because they can obviously create more profit. There'll be a much more profitable business in the long run, and obviously the earning reports will be much stronger. So they'll necessarily bring those dollars back to the US. Now, because that's very supportive of those equity prices, i.e., well, they're going to be saving millions and millions of dollars per quarter on such an economic policy. That is going to lead investors to create more investment or to look to increase demand for those equity shares. So does that make sense? Of course, if the organic health of Facebook is going to improve because of an economic political shift in a tax break, well, that company is now going to save, let's say, $200 million per quarter, and of course it's likely to be much more. That is going to be strong for the share price. So traders will look to invest, or investors alike will look to invest in these companies. So we see further capital flows going back into US denominated assets. Okay, so that's effectively what is happening in those firms. Will this increase capital flow into the US? What does that mean? Of course, we've discussed it's going to increase the level of investment into such firms that are benefiting from the tax breaks. We have a positive capital flow starting to increase. However, will this increase overall capital flow? What will it do to the currency? Of course, if we see all of a collection of European traders perhaps interested, the financial community here in Europe is interested in these shares, as we see growth in them over the long run due to such tax breaks, we're going to invest in them. We're going to literally change our European currencies, whether it's the Swiss franc or the euro or the pound sterling. We're going to change that into US dollars. That's a simple transaction when we look to buy these dollar denominated share prices. Okay, so that's going to increase the demand for dollars as well, and we're going to see positive capital flows as a result from such an economic shift. Now let's discuss then negative capital flows, and again this is simply the opposite. So again, we have generally emerging markets as a very good example. Generally there is much less investment going into emerging markets rather than highly developed free markets here, maybe in Europe. Now, why is that the case? Of course, well, a simple capital flow. A lot of these countries are experiencing negative capital flows, which means the amount of money, the amount of investment coming into the country isn't the same as the amount of investment going out. So if you're to choose perhaps a Latin American country who's one of which is showing some growth, of course, perhaps Brazil is starting to show more growth. It is, of course, needing to extend that growth by doing business across the world, more relationship building, more trade relations to extend business relation and creation of that business. But in fact, European countries, of course, will not be doing the same level of business or transactional cost or capital flow transaction with Brazil as it is attempting to do. So it's effectively living under a negative capital flow ratio. And there are many of these countries, if we think of the amount of capital investment that goes into the US financial assets in comparison to some other Latin American countries, perhaps or other less developed Asian countries, Vietnam, Thailand, perhaps, well, it's just not the same equation. Generally, if we think of things we buy online, we're deciding to buy something from Amazon. It may be in the US, of course. That is effectively a choice for us to change. Foreign exchange here, it's an actual transaction where we decide to change our euros for dollars so that we can purchase off a lot of these, commercial websites, of course, or other business. That's just simple one example. But here, emerging markets they are a severe disadvantage, and we can literally see this on chart depicted by non-residential capital flows as opposed to residential capital flows. Okay, so as we follow across the line chart there, we can see, well, there's a severe sort of inequality between from roughly around 1995 to the latest price, obviously 2015, and then the forecast that they are running a trade deficit the whole time in terms of the capital flow moving in and out of the economy. Here we have the non-residential capital flows, and again, you can see it's always outweighing the actual level of capital flow, more or less, that's actually going. And here's the residential capital flow. Again, our line dictates the net capital flows here, which is the most important factor, running an actual trade deficit the whole time. Okay, so again, this is a real function of how we start to price all of these things in together. So a question I would like to pose, just thinking logically about what we've discussed with the negative capital flow ratio, more capital is in fact being invested into that country from other parties than vice versa. Of course, did you ever ask why the currencies of some of these countries are so cheap in relation to the dollar, euro, or the pound? Okay, so perhaps the South African rand there to choose one. It's relatively cheap towards the US dollar. I believe it's around 17, 16 rand per dollar. So, it's much more, it's at a severe disadvantage in terms of pricing that currency towards the dollar or other currency pairs because of capital flows, because there's not as much demand for business creation or investment in those assets, those residential assets going into that country as there is going out, okay, in terms of other invested currencies. And here we have emerging market capital investment. This is something we can literally see in terms of what we're describing in the equity markets. Okay, so we have MSCI emerging markets here, the level change, of course, in relation even to the S&P 500, the level change there, of course. So just think of it as an investor. If you're investing in US equity markets, perhaps you are a portfolio investor or a pension fund, and you want to pick 10 stocks in the US. Well, as a weighted average, the S&P is going to deliver something like 57.97%. So that's a fantastic figure in terms of investment. So I want, of course, that level of return. That is a very strong level of return. If I know emerging markets are delivering perhaps more risk, but are only delivering 9% return, it's still a strong level of return for equity investment, of course, but which investment am I going to choose? Which portfolio of investments am I going to choose? It's of course going to be, the US denominated S&P shares. So I've actually chose to forego this level of investment, choosing a higher level of return. Of course, that's natural instinct. You're hoping to make a stronger return for every investment that you do. And of course, as a function, what I'm going to do then is change my euros, perhaps 100,000 euros, into US dollars. So that's creating more demand for US dollars and is effectively, as a function of my choice as a trader or investor, has foregone an increase in demand for the relative currency here for the MSCI index, or perhaps South Africa again as an example. So that is effectively the disadvantage in terms of not only currencies but equity demand or capital flow moving in from one country or region to another, that as an economic agent or trader, you can look for stronger, more attractive investments elsewhere. So let's discuss then these trade flows. Trade flows measure the balance of trade. Simply, that's what we define, okay? The balance of trade. Now, take this note, the balance of trade, because this is going to be of significance as a trader, and you're going to understand a lot more about the economy when you understand the function between imports and exports, okay? So this is the amount of goods that one country sells to others minus the amount of goods that a country buys from other countries, okay? So a simple function between exports and imports. This calculation includes all international transactions and represents a country's trade balance, okay? So if you're one country and you're, perhaps running a very strong level of trade balance, you're exporting a lot of produce to the world and making a lot of money from that produce, from that output, but you're only spending a little in terms of importing the goods needed to produce such quantity of goods, well, you're going to be a very successful young economy. So that a country is like any business. It runs itself like a business in this, I suppose, business life cycle of economics. Currencies that are associated with long-term trade surpluses will tend to strengthen against those associated with persistent deficits, simply because there is net buying of surplus currencies corresponding to the excess of export over imports, okay? So when there's an excess of exports over imports, that's of course a trade surplus, and vice versa, we're going to have a trade deficit, which we'll discuss. So let's discuss then importation. Countries that are net importers import more from international producers than they export to international clients. Net importers run a trade deficit. Okay, so net importers, they run a trade deficit. This is due to the fact that they produce more foreign goods than they sell to the international market. Okay, so if you're producing more goods to the international market, of course, than you're producing, you're going to be running your economy, such as in order to purchase these international goods, importers must sell their domestic currency and buy foreign currency. This is quite literally foreign exchange transactions. This is literally what you're seeing at a macroeconomic level. Thousands, hundreds of thousands of economic agents. It's ourselves, it's large financial institutions, it's large businesses asking for loans, it's any company that is doing trade with another part of the world. This is quite literally constant foreign exchange transactioning. The result then is what we see. This causes the value of the domestic currency to fall. Okay, so large importation is going to effectively lead to depreciation of the currency as such, because we're seeing net importers run a trade deficit. Again, we'll use the United States as an example here. The United States has the largest economy in the world, yet still runs a considerably large trade deficit with its biggest trading partners, and a substantial global trade deficit overall. Okay, so the US, it's a very successful growing economy. Of course, we know that. It's the largest economy in the world, but it has a very substantial trade deficit, particularly from some large countries there. We have, as we look across our charting, we have $347 billion there, and that's maybe 1.5, 2 years ago in 2016 with China as a trade deficit. Okay, so effectively there's some sort of ambivalence or disequilibrium between the amount of trade moving across nations from China to the US, totaling a value of 347 billion. Okay, so that's absolutely huge in 2016. That's a lot of capital. Okay, and we see Japan, Germany, Mexico, Ireland as well, actually outperforming in terms of their level of trade with the United States. Okay, and then we have some small countries. You can see it has a trade surplus, but albeit relatively very small, with Hong Kong, Netherlands, United Arab Emirates, Belgium, and Australia. So effectively, you can see if you're running an economy like this over a long period of time, you're going to develop a large, what we call the fiscal cliff, or a large trade deficit. For the month of February there, 2017 alone, so very, very recently, the trade gap between the US and China totaled a 9-year record high of $57.6 billion in 1 month, guys. In 1 month, so that is very significant. The amount of trade China is doing with the United States is completely overriding the amount of trade the United States is doing with China. That is causing severe currency effects, and of course is increasing a lot of capital flow into China from the United States, which is great in terms of business for the US, but not so great for a business in terms of outgoing business for the US. Again, so we see the US faces a widening trade deficit with China. As that story continues, we are now in this perplexed curve, and this is a serious concern for US investors as well, whether this continues to grow to the downside. Again, it's going to be supportive of Chinese markets, again, if it continues. Now we'll move on to exportation. Okay, so countries that are net exporters export more to international clients than they import from international producers. Okay, again, it's just the opposite thing. So exporters, again, net exporters are those that export more to other countries or nations than they actually import from other clients, international clients. Okay, the net exporters run a trade surplus. Again, we can use Switzerland like this because we talked a lot about this in the sector analysis lesson. Switzerland is, of course, one of the largest has one of the largest trade surpluses for the size of its nation in the world. Okay, and this is due to the fact it does an increasingly huge, a vast amount of business with the world, and it's a relatively small place. In fact, it has a very strong financial services sector, has a very strong pharmaceutical sector, and those tentacles to a lot of those large companies reach a global scope, global landscape in terms of the business and wealth generated for that type of business. Okay, so this is due to the fact that they sell more goods to the international market than they purchase from the international market. Again, demand for that currency then increases as international clients must buy the currency in order to purchase these goods and services. Okay, so let's just sit back a minute and reflect on this. Okay, it's something quite familiar to us. We know that the Swiss National Bank has tried to manipulate its currency. We could think of many reasons why they do that, but the one is obviously to gain a level of competition as their currency is repressively, it continues to grow stronger. Why does the Swiss franc continue to grow stronger across other currency pairs? Well, simply because it has a very, very strong, consistent trade surplus. It's a very small country. It does a lot of business, and that business that is generated perhaps Swiss German business or Swiss Russian business. Perhaps Russian importers like to buy a lot of chocolate in Nestle, or perhaps they like to, there's a lot of investment going into Swiss finance and insurance. So that means that there's a lot of capital coming from these other countries into Switzerland. Them countries are changing their local currency into Swiss francs, again creating a lot of demand for Swiss francs. And with simple supply and demand that we discussed there with market forces, you know that a large shift, a large increase in demand will effectively have a relative change on price. Foreign exchange is no different, and that is effectively what we see across the spectrum of the Swiss franc in relation to its trade surplus. So what is the result? This causes the value of the domestic currency to rise. So those countries, more generally as a function of economics, who run a trade surplus, will see their domestic currency rise. With exportation, we can use two other examples here to really get a full picture of how important export is in running a country. Again, running a country is much like running a small business. You need to figure out where the income is coming from and where your spending is going, and how you can make profit. Both Germany and Ireland have relatively small economies in comparison to China or the United States. However, given the makeup of their economies, they run on an export-dominant business cycle. They both actually produce more goods and services for the international markets than they do for their own. Okay, so they do more business abroad than they do locally. As a result, their export functions are a significant part of their gross domestic product. Okay, so let's just look and observe the chart here. And again, if I think just towards Germany, well, we know it creates a lot of chemicals. It's a large producer of chemical manufacturing. It creates a lot of automobiles for the global market, and I would assume such companies as Mercedes and BMW, of course, with Daimler there, they create a lot of income towards the growth of the export market in the German economy. Effectively, this is what we're seeing here in terms of the relative move on GDP, or gross domestic product. Well, it's quite significant. The export market has been booming in Ireland up until 2012. Of course, this is a little backdated there, but what we've seen again, Germany is very, very strong. It's just relative in terms of how we are performing. Germany is in around 40 to 50% its export market share, as opposed to a relative level of GDP. So effectively, it's creating 50% of its GDP in-house or locally, and 50% of its GDP from exports by producing and selling goods abroad. Okay, and that's creating a strong level of demand for obviously the euro in Germany as well.